Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. ETFs have been gaining market share from mutual funds for many years now, and according to Cerulli, that trend doesn't look to be slowing as a research firm forecasts AUM within ETFs will grow by 9.5% annually between now and 2026 while mutual funds AUM will decrease by 2%. There is also a subset of ETFs that is surging in popularity, and that is active ETFs. Today, I have on an industry leader in active ETFs on the show to provide some insights into the popular investment vehicle. But first, today's episode is sponsored by the award-winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions. So I'm honored and very excited to welcome Noah Hamman on the show. Noah is the founder and CEO of AdvisorShares. Thank you so much, Noah, for coming on the show. I really appreciate it. It's an honor to have you on. Can you please tell us a little bit more about yourself and AdvisorShares?
Sure. So for me and the company, we've been doing this now for, I guess well over 10 years. We launched our first product in September of 2009. Before that, I did have some other ETF experience. I was part of the team to launch ETFs at a firm at the time was called Radix Investments, but later switched to Security Benefit Life and then now Guggenheim. And the most interesting product that we launched there in our first product was the equal weight S&P 500 RSP. And so that really set me on the stage. I learned a lot about ETFs and created the opportunity to come here to AdvisorShares. And we weren't the first to offer actively ETFs, but pretty close. I think we were third behind PowerShares and one other firm I can't think of right now. But we've been in this space for a long, long time. So much has changed in the actively managed ETF space, and as you mentioned, this seems to be on the cusp of a really good opportunity where people are looking at all types of strategies, but within that ETF structure.
Yeah, fantastic. So, you mentioned ETFs and I mentioned mutual funds. And so, compared to other types of investment vehicles, you know, active ETFs, you mentioned 2009 was when you released your first product. So active ETFs are relatively new when you think of the grand scheme of things. So can you please provide us a brief explanation of what sets active ETFs apart from traditional ETFs?
It's pretty simple. And for us, it's just, index versus active. And in some ways they're very similar, right? You take an index like an S&P 500, which at the end of the day is, picked by a group of people with their own, sort of methodology and way of selecting it. In some ways, actively managed ETFs are the same thing. We're not passively replicating an index, but you could have an index as a benchmark that either one, you want to track closely, but maybe outperform. Maybe you want to replicate it, or you're just simply, have a tactical asset allocation and you might be a little bit of everywhere and you still probably have a benchmark that you want to beat. But ultimately that's what active is we try to use the phrase that, someone's holding the steering wheel within the ETF portfolio, trying to make decisions within the limitations of the prospectus, of course, but trying to, add some value in that process, which is incredibly difficult to do. But the structure really adds a lot of value to active managers versus, say, the mutual fund structure, which has probably it's less cost efficient to operate. But when you're looking at a portfolio managers, especially an active managers, performance return, the basis points that you can achieve in net performance, but because of some of the structural advantages ETFs have, is a real advantage for active managers as compared to operating at least in a mutual fund structure.
Interesting. Is it because there's just more liquidity? You can trade throughout the day, mutual funds, you have to wait till the end of the closing day. Is that one of the structures that kind of benefits active ETFs?
A little bit, though. A lot of the things that you just mentioned really benefit the investors of actively managed ETFs. So you can use limit orders and you can put risk management tools in, right? Like a stop limit order or things like that. They're even a little bit easier to hedge if you're so inclined to do, something like that with an actively managed ETF. But the things that benefit the portfolio manager are really the things that, cause less friction inside the portfolio, that creation unit process, the redemption unit process. But in the mutual fund world, that's sort of cash in and cash out. In the ETF world, if you're an active manager, you don't have to put all that money to work. The shares can come in kind. You have some flexibility. But man, the cost savings of not having to deal with the commissions and the spreads and everything else. And so it puts the cost of activity. So if you want to be an active trader with an ETF, well, as an investor, you bear those costs, right? You pay whatever commission you're paying, which most of the time is now zero. And so you carry that work and it doesn't go on the backs of the other investors. And so it allows that portfolio manager to be way more efficient, much more tax efficient if they want to be. So it's really that side of it, the internal side, that can give that portfolio manager. And I think at the time when Eaton Vance, I remember, came out with their first actively managed ETFs, and I think this was maybe some of the less transparent thing, but they had taken the time to do some analysis of what could be those operational savings. And it varies from product to product, of course, but they'd put out a number of upwards of 75 basis points of operational cost improvement you can see, which is great for the investors, right? That goes to their bottom line. But again, if you're you're an active manager and you're trying to figure out where and how you want to manage money, if you thought, wow, I could get a plus or minus 75 basis point leg up compared to a mutual fund structure, that's pretty attractive. And so it just makes it a great structure. And again, I would argue it makes ETF such a great structure for active management, almost more as if it was better designed for active management than, say, passive management, where a portfolio manager really doesn't want to make a lot of changes.
Interesting. So a lot of benefits there that you just listed for active ETFs and the pros to them. Where do you see most growth potential in active ETFs? Are they becoming more popular, potentially like in plan sponsors, employee based, or just retail investors? Are they growing there?
I see the interest across the board, to be honest with you, from retail to financial professionals, and in some cases, maybe institutions. And I think it's interesting because I don't know that when people are buying an actively managed ETF, they're buying it because it's active. They're buying it because it's interesting, or it does a certain thing, or has delivered on certain results. And now what you have, at least within the ETF industry, because remember, we went through sort of this period of time where, they're creating indexes like crazy. And it was because it was so much easier to build an index-based ETF than build an active.
Mhm.
Now you don't see that anymore, right? It's not really worth the cost and the time and the effort and the money to put that into it and create the index and disseminate it. So that cost savings is a real advantage, again, when you're thinking about building, your strategy into a structure. So it's interesting. I'd maybe make a couple of points. One, I don't know that people are always cognizant of the fact that it is active. They happen to be active, but they like the strategy or the numbers.
Yeah.
And I think two, remember that, even though so much of the money in the ETF space is in index-based products, and thus you would think most of the investors prefer passive management.
Yeah.
You look at the trading volume on these ETFs, and they are the most actively traded securities on some of these exchanges. And so people are clearly being very active, but with beta baskets. And now they have far more choices to be active with alpha baskets.
Interesting. So you perfect segue. You brought up alpha. When looking for an active mutual fund or an active manager, one of the most popular metrics is alpha. Is that manager providing any alpha? And that's one of the reasons why you turn the active management. Is that the same with active ETFs and, focusing on alpha? And what are some other characteristics a financial advisor should look for when searching for an active ETF?
A good question. So I think in general, yes, people are looking for alpha when they are, intentionally selecting an actively managed exchange traded fund. And it's that thing where I always say it's hard to produce, but easy to find. So we've seen plenty of studies where active managers are underperforming indexes. Though again, interestingly enough, if you apply that, plus or minus 75 basis point performance difference, you would have a pretty significant number of active managers who actually might leapfrog their benchmark by, 10 or 15 basis points. But if that's net of fees and everything else, that's pretty
Right.
impressive because we know how hard that is to do. But again, in general, hard to do, hard to deliver. easy to find, right? There's plenty of investment tools out there, Zephyr included. I heard you mention them earlier that can help people find good managers. And I was going to say good strategies, but it really is ultimately up to the manager and the decisions they make in terms of producing that alpha. So yeah, I think that's what they're looking for, and whether investors are using actively managed ETFs and being tactical or active with them, and so they're trading in and out of them when they work well, or whether they're looking for a product that they're going to buy and hold forever, and then they hope to deliver that outperformance over the long term. Both are out there, both are available, and so that's ultimately the best thing I think about ETFs is it's created so many more choices for investors and advisors to use when building portfolios.
Yeah, I completely agree. I think just the evolution of this space, when I started, it's mostly mutual funds or, you know, stocks and bonds, right? And now you've got ETFs, active ETFs, separately managed accounts are, gaining popularity amongst the retail investors. So, and it just helps create better investment portfolios that are better suited for each individual client.
Right.
Um, you know, we talk a lot now, pivoting here a little bit. We're about to enter a new monetary policy regime in 2024. The Fed, we just mentioned pivot, as the Fed pivots from rate hikes to rate cuts. How can financial advisors prepare their clients' investment portfolios for this regime shift? And is active ETFs one of those ways?
So definitely yes, active ETFs are for sure one of those ways for them to do it. And the interesting thing is the answer is a little bit of maybe the comment that you made around how advisors really can customize. So, some of these things are also, or these decisions are a function of what does the client look like? What's their risk tolerance? Are they 20? Are they 40? Are they 60? And so depending on the answers to those questions really might depend on, what that advisor is looking for in terms of their client base. And so, with interest rates, going up and then now possibly going down and thinking about, that might affect portfolios, which to be honest with you, if I were an advisor, I would be far more concerned maybe about the Fed balance sheet than interest rates. In fact, really for me, interest rates I felt like could be positive. Interest rates and maybe the combination that we did have with inflation could be positive for stocks, but in a bad way, right? You're paying more for the products that you're buying that these companies are selling, so the revenues are going higher. Now their costs are going up higher as with it, but when they can hit a better top line number, that has a tendency to make the stock go up. So now, I mean, we're still on a bit of a inflationary environment, but maybe rates going down. I think that will calm things down a little bit. I hope, stock market volatility wise, things can be a little bit better. But if I were an advisor, I'd be far more focused on, when and how the Fed's gonna adjust or lower that balance sheet because the liquidity it provided sort of post the financial crisis, post the pandemic, has done wonders, right? It's shocking to know that we are up, almost 50% from the pre-COVID highs. You wouldn't think you could shut down, just about the planet and be there. And I think there's many reasons why we're there.
Yeah.
But one of them certainly is multi-trillion dollars of liquidity that the Fed provided, and to the extent that they have plans on pulling that back anytime soon, that's what I would be concerned about. And then, of course, absolutely, there's plenty of tools available in the ETF space. Even in our own, we have hedging tools that are available that you can turn on when you want it and turn off when you don't. So yeah, there's plenty of strategies out there, both beta, but probably more active are the more interesting ones, especially some of the tactical asset allocation strategies that are out there, which typically are active, can be great tools for advisors to consider using.
Let's go a little bit further into that. Let's talk maybe some specific ETFs that AdvisorShares manages and offers that maybe might benefit from this new environment of falling rates. Are there some right offhand that maybe financial advisors should look to?
So, in terms of just falling rates, I'd probably think of it more broadly in terms of maybe the market having more challenges, right? And I would, maybe suggest, or I'd present maybe three different items, and sometimes it's a function of how aggressive, experienced the advisor might be. And I'll start with maybe the most aggressive one, which is the ability to short. We have two products on our platform that are just stock picking short selling strategies.
Okay.
And one of them, HDGE, has a really long-term track record. We launched that in 2010. So if
Well,
you think about what the market's done since then, and you look at the performance of hedge, you might look at that and say, I'm never touching that product because it's down 80, 90% over that long term. But the reality of what it's done is it can more than outperform the decline in the market during those bear market periods. And so that's the tool, is that unlike the ones that reset daily, so those are different. Those are really for active traders. This is more traditional short selling. And most people are shocked to know that this exists with full transparency in an ETF structure. And when you look at the market timeframes when it's been bad, man, those products have shined very well. And so that becomes a tool that if an advisor is concerned, right, it's a 0.5%, maybe it's a 1%, 2%, 3% allocation, depending on, how concerned the advisor is. And it's not blindly shorting good stocks along with bad. It's trying to find the ones that will struggle. Not to say they're bad companies, but just stock prices that will struggle for particular companies. And it's a great tool that an advisor can use and find some alpha in that overall portfolio. But there's still other things they can use. QPX is a tactical asset allocation that comes to mind. So it's one that I would say, as an advisor or an investor, you probably don't want to try to time the tactical manager. You're buying it because you're letting that manager move around. And they're one of the few products I've seen post numbers as good as, the Qs, this year.
mhm.
So to be able to do that and be tactical, is an impressive result. So there's products like that that advisors can just add in and hold for, for some period of time. And then maybe the last one is just thinking about, concentration, right? We're in this world where it's FANG and the Magnificent Seven, that's driving the returns. And we had just a little hint last year in 2022, early 2023, where value is coming back into play. People had almost forgot that word as part of their investing portfolio. So I think of someone like an Eddie Elfenbein, with the CWS ETF. He's not in any of the big tech stocks. He's keeping up with the S&P 500, and he's finding it in a sort of very Warren Buffett kind of way. Small number of stocks, only invest in the best ones, and your goal is to buy and hold them forever. It's very low turnover. So it's one that it'll go down if the market goes down, but it probably won't go down quite as much as some of these big higher flyer strategies.
It's interesting you brought up hedging and the shorting strategy. It's one of those things where, you may look at it since 2010. It's like, why am I holding this thing? But it's all about insurance, right? You got to
True.
think of it as insurance. Yes, I hate paying homeowners insurance and car insurance, and you don't use it. You think it's a sunken cost, but when you do need it, it
Right.
comes in very handy, right? It's one
Very
of those
handy.
things that maybe you can't look at it all the time, but
Right.
it's there to help you. And in terms of, your strategy about, not investing in those magnificent seven, but in value names. And I'm a firm believer. I do think in 2024 we're going to see, because rates are falling and other things are kind of normalizing in the economy. I think we're going to see more breadth within the market, and the winners kind of broadening out a little bit, and hopefully that will benefit more of those, value names and very high quality names that have solid balance sheets and
Right.
revenue generations moving forward.
Right. And I think we've seen that as of late, right? This is what,
Mm,
mid-December of 2023. And most recently, it feels like I've seen, the equal weight S&P 500 outperforming the cap weighted, which tells me, those companies in the middle and the bottom of that index are doing, well enough that in aggregate they're outperforming. So yeah, I think I agree that you're starting to see that tide turn already.
yeah, yeah. Looking at your website and some of your products over the past couple of weeks, there's a couple that really intrigued me, and they're more the thematic ETFs. Let's just start with the hotel ETF. You would think since the peak of the pandemic, people are traveling, services, and I'm assuming the hotel ETF has done fairly well over the past couple of years.
It has, but I would argue sort of in gaps. There were times it was easily outperforming the S&P 500. If you look at it since inception, with the S&P so heavily influenced by those tech stocks that have really ramped back up, it's lagged the S&P as of late. But yeah, absolutely. It's in part why we built those strategies is, one, we thought they would be great tools for the long term to really allow an advisor to focus when they're investing in those sectors. But two, we also felt like maybe the timing was going to be good coming out of COVID. And it was
Mhm.
interesting. We got them launched, there towards the end. But if you remember, we kind of opened up and then we kind of shut back down a little bit. And then it was like, oh, I'm not sure we're really going to open back up again. So they've been two strategies that have been interesting to watch. It looks like, it still may take some time. They're smaller from an AUM perspective, but we're seeing more and more of it. Even something like the Jets ETF, that's not our ETF, but it's a good product. It was around for about a year and a half before it really saw any traction. And interestingly enough, pre-COVID really took off. It grew almost $2 billion, and people are starting to see the value of getting a little bit more granular in terms of how they allocate their portfolio.
And that goes to, I'm on the California side of Lake Tahoe. So this next one, cannabis, the
Ah,
cannabis ETF, right? You would think more and more states are legalizing it. It's becoming more popular and mainstream, but there's also still a lot of uncertainties about regulatory issues, and it's very political in terms of Republicans, Democrats, and so on. You offer pure cannabis play. Can you tell us more about that ETF?
absolutely. That's another one where we've been working on the strategy for a while. There's these companies, many of them are small and micro cap strategies. So that in and of itself makes a strategy a little bit tougher to build. And then, as you point out, the federal challenges, it's still Schedule One drug at a federal level. And so that made it difficult relative to things like custody. And, we work with the Bank of New York Mellon as our custodian. They have a hard time holding those stocks for federal reasons. So we had to come up with a unique structure, one where we had to buy them actually via swaps, though over time we think that will change. But I think that's the piece that is really missing. And when we finally got to a point where we felt like we could build the strategy, everyone agreed the exchange listing venue. We had to, share an opinion letter with the SEC. We had to go through these different hoops that you wouldn't normally go through to launch a product, but everyone wanted to feel comfortable that, they were abiding by the rules, which makes sense. And we did it at a time too where I think, well, we all thought probably things would be more friendly at a federal level for
Mhm.
cannabis. I think Biden campaigned on the promise that day one he would, decriminalize, it wouldn't legalize per se, but just, you wouldn't have to get thrown in jail for having, a plant on you. Um, that hasn't happened. And so that's made it really challenging. It took a strategy that I remember when we launched it at roughly $25 a share, kind of a typical number you might start with.
Yeah.
It shot up a little bit, almost double. A lot of money flew in, and then no federal changes came in.
Yeah.
And so we saw two things happen. One is, not surprisingly, prices of the underlying stocks have continued to drop, little blips up, here and there, but continue to decline. It looks almost like the inverse or our short, ETF. But interestingly enough, we've only continued to grow our shares outstanding in that fund. So investors have continued to buy in. They believe at some point, they just don't know when, and we don't know when either, that things will change at a federal level. But we believe that's one of those strategies where these companies are operating, as you mentioned, successfully, challenging, but successfully in some states. They have a overly burdensome tax structure with 280E because they're Schedule One. So it's that, that people call it the Al Capone tax, right? They didn't get them on the criminal activity, they got them on tax evasion. Um, and so it's that rule that they put in place for things like, criminal activity, that in a weird sort of a way, even though all these companies are operating legally, the product's legal, all of those things, they still are penalized from a tax perspective. So it's, trying to compete in business with an arm, maybe and a leg tied behind you, that when these things change, I
Right.
wished I knew when, it's going to be an interesting investing place. So thankfully, we're seeing shareholder behavior reflect that, right? Because I don't think anyone's going to get the timing right. So
Mhm.
you've got a lot of people that appearingly are dollar cost averaging, believe in the sector, and hopefully things work out well.
And it's a long-term play. One of the I'm gonna end this one with arguably the one that I had the most questions about and really piqued my attention is the psychedelics
Mm,
ETF. What
yep.
are you guys doing with psychedelics ETF there?
It's for me and for us and our approach and the strategy and the idea, it was sort of all about natural medicine, right? Cannabis
Mhm.
obviously used recreationally, but when you look at the medical applications for a plant that hasn't been that, aggressively researched and studied, and I believe they'll find a lot more to do with it, Man, psychedelics is falling right into the same category. Some of the medicines and psychedelics, again, for us, far more medical. I know there's an adult use component to it, but some of the things that they are accomplishing in these trials and tests around depression, around,
Okay.
people having those feelings of suicide, even traumatic brain injury. We've talked to NHL hockey players who have gone through treatments and have literally changed their lives from, wanting to kill themselves to not, and wanting to live and getting their brain rewired, and not being a doctor, I'm not sure that I can adequately explain it all. But what we've seen from some of these companies, it's been amazing.
Okay.
It's probably in a better place actually than cannabis, because you have things like a ketamine, which is legal, not a Schedule 1 drug. It's a derivative of the mushroom, and so it falls under the psychedelics category. And so that's what you see. You see a lot of work done. I almost call these biotech investing's very aggressive investing, right? Trying to build medicine, and a lot of it doesn't work, and you hit one and it's amazing. I think psychedelics is going to be that on steroids, right? They've got so much work to do, so many medicines that they're working on, capital needs. When they hit on one and they can get approvals, I think it's going to be amazing opportunities for these companies. But this is also another kind of play on emerging, but also natural medicines. And so, how that plays out over time, we'll see. Federally, they're in a better situation than cannabis, but I think from an investment perspective, I think cannabis will be different, right? I think when we get federal changes, that's going to help every cannabis company. But if one pharmaceutical company has, something approved, well, that helps them in that one particular medicine that they've created. It doesn't help all the companies in the space. So psychedelics will be really interesting. The discoveries they are, coming up with through their testing and trials have just again been amazing, life changing for people. It won't be for everyone. Not every medicine is for everyone. But when you think about an industry that can really revitalize and change some things relative to how we deal with health and mental health issues and things like that, man, this is an interesting category to be investing in.
That is really interesting. I'm glad you brought that up, because to me it sounds like there might be more research and opportunity and money put into those type of companies than say a cannabis company,
Right.
right? Because it's going to mental health, and mental health is such a mainstream, like important topic.
Yep.
So very interesting there. I'm glad we talked about that one. Talk about ETFs real quickly. What are your thoughts about the upcoming potential Bitcoin ETF?
I'm actually nervous it's going to make the price of Bitcoin go down.
Oh, really?
But I think and I say that in part because when I look at Bitcoin, it really is interesting. I guess in some ways it's a little bit like a money market fund, right? You're buying some dollars in a money market fund, but you could just as easily hold those dollars anywhere else, right? In your pocket
Yeah.
or in a bank. And so that's the interesting thing about Bitcoin, and I say especially as compared to cannabis, right? Cannabis has issues with investors because of, depending on what firm you're with or with a bank, they won't hold it, they won't custody it. But if
Mhm.
you want to buy Bitcoin, you can buy it, it seems like fairly easily, right? In your Robinhood account, and
Yeah.
Fidelity's got a program to buy Bitcoin. You can obviously open a Coinbase account. So it feels like one of those investments where I'm not sure that the ETF makes it better, right? Think about what ETFs did with bonds, where bonds were traded on desks and some people had inventory and others did, and you didn't know. And then you're negotiating the prices. And it took something that was very less transparent and made it a lot more transparent and easier to trade and easier to value and understand. I think Bitcoin's already there. And so I don't know that the ETF structure dramatically improves it. It makes it easier to hold it in a brokerage account, but some brokerage firms have abilities to hold that thing already. And I'm probably in the camp that if you genuinely want the investment return stream, ProShares, I think
Yeah.
it's BITO is the ticker, has a billion or so in it, maybe doesn't any, well, it probably has more now. The price is up. That works well too, right? It's that whole sort of GLD versus gold futures. I think from an investor perspective, it doesn't matter as much. And then I think it's one of those things from a purist perspective, right? If there's other reasons why you might want to hold the physical, well, you're still not really holding the physical, right? In GLD or a Bitcoin ETF, even though they might be, you're not.
Yeah.
And so yeah, I'm nervous that the ETF doesn't give Bitcoin from a pricing perspective what it's looking for, but I think Bitcoin finds what it's looking for from a pricing perspective as more people are willing to adopt it and trust it and move capital around, that's going to be the real opportunity, I believe, with Bitcoin. Not so much the ETF. The ETF will make it easy to trade, which is awesome, and maybe take some volatility out of the price, which would be nice. Um, but yeah, I think Bitcoin's opportunity is far more to do with everything else that's going on with it, and less whether or not someone has a physical because it's
Yeah.
Bitcoin, ETF.
That's really interesting point of view. And one thing I always, BlackRock has an application out there for Bitcoin. It's like, so, and I need to look into this more, but does it mean BlackRock has got a wallet, full of Bitcoin that in order to have an Bitcoin ETF, they've got to have Bitcoin somewhere,
Yep.
right? So
Cold
have they been
storage. Yep.
accumulating it over the years, or all of a sudden when it's approved and they start seeing flows into this ETF, then do they go out and start buying Bitcoin? There's just those type of questions that um,
Yeah. I mean,
I
the
just,
custody, who's holding the key, how many different people are holding the key, the cold storage component. Boy, it's going to be very, very different, for sure, and interesting. And that's what I love about the ETF space, right? Even if Bitcoin's not your thing, it's somebody's thing, and the
yeah.
choices that are available in this structure have been amazing.
Yep. And it goes back to one of the very first comments you made. Like, it's just providing investors, at the end of the day, investors more options
Yeah.
that, align with their unique investment objectives. Lastly, real quickly, what are some misconceptions maybe out there about ETFs, active ETFs?
Well, probably the biggest misconception about active ETFs is that the manager is constantly trading in them. So remember, you can package managers that don't trade a lot and some that want to trade a lot. High fees is probably another misconception, at least about the concept of active. We're a smaller shop. Our fees probably lean on the higher side, right? But that's a function of profitability.
Mhm.
It's really the size that allows you to price, far more aggressively. So yeah, look at active ETFs closely. I wouldn't, filter them out just because you're worried that the prices will be higher. So those are probably the two that most come to mind. But otherwise, I do feel like people hear the phrase actively managed ETFs and they think, oh, that's new and different, and I don't understand it. They're just like index-based ETFs. It's just like
Yeah,
the mutual fund world. You have both, same structure, just different flavors. And I think as more people understand that, and I think they are, in part based on what you were talking about with the adoption of them. I think they're just looking at them as a structure. And do I like the strategy and the results? They're not really caring that much. Does this have a benchmark that it's passively tracking, or is it just delivering good results? I think they're just trying to find good products that work for their portfolio.
fantastic. Thank you so much, Noah, for coming on the show. That was a
Thanks, Ryan.
fantastic, very fun conversation. It's been a pleasure to have you on. I learned a lot. Where can our audience get more information about Advisor Shares?
So I'd go two places, advisorshares.com. Of course, our website, you'll find great content there, but try to follow, I guess, probably follow our X account. We have it on LinkedIn as well. The Advisor Shares account there, it's just add Advisor Shares. And what you'll like there is we've tried to be a lot more aggressive, especially as a smaller firm with social media. We have a live show during the week called the Alpha Nooner. We'll bring on portfolio managers. And so no different than the ETF structure. We're trying to get information, content, education out there as much as possible, be very transparent with it. So I would, go to the website or certainly follow us, on X or LinkedIn or someplace like that to get our insight there.
Fantastic. I will definitely do that, and we'll put that in the show notes. So
Thank you.
thank you, everyone, for listening. Thank you, Noah. Fantastic conversation. Thank you for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Adjusted for Risk YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much, and have a great rest of your week.